Today, we're going to talk about one of the most important financial metrics that exist, and that is the PE ratio. If you are an active investor that picks individual stocks for your portfolio, or you choose individual sectors within the stock market that you think will perform better over time, you must understand PE ratio. Even if you're a passive investor who mostly chooses to invest in, let's say, the SPDR S&P 500 ETF, and you don't believe in timing the market and you don't believe that markets are inefficient, you believe that they are efficient, you should still understand PE ratio because it is a very quick way of understanding market sentiment and the overall risk levels that you're accepting when you decide to jump into or out of the stock market. So let's go ahead and jump right into it. So the PE ratio is price per share divided by earnings per share. Okay? That's very simply what PE ratio is. But let's go ahead and jump into a specific example. So let's pull up Apple. And you can see here at the time of recording this that Apple was trading at $152.29 per share. And the PE ratio for Apple, according to Seeking Alpha, is 12.57. We're going to go ahead and ignore the fact that this is a forward PE ratio. We'll describe what that is a little bit later on in the video. But for now, just understand that the PE ratio for Apple is 12.57. And that is calculated by taking this $152.29 and dividing it by this EPS of horrible arrows. This EPS of $12.12. And that's going to give you 12.565, which rounds up to be 12.57. Now, more important than understanding the calculation of PE ratio, because most of the time you're going to use websites or tools that will do that for you, is the interpretation of PE ratio. Now, if you look online and if you look at how most teachers go and approach the interpretation of PE ratio, they'll usually tell you that PE ratio tells you how much you're paying per dollar of earnings. And that is a phenomenal explanation, except for the fact that every time I've tried to use it on students or anybody else that I've taught PE ratio to, most of the time that doesn't sink in right away. So instead of saying that, I know for some of you that might work, we're actually going to go ahead and use an example that I think should hopefully make the point a little bit more clear for how useful PE ratio can be. So let's say you have a friend, this is your first friend, and they have $100 worth of revenue in their lemonade stand business. We're just going to go with the typical example that's used in pretty much every educational material ever used. But it's good. You know, we got the lemonade stand, all right? They make $100 a year, they have $90 worth of expenses, and they have $10 worth of profit. This friend is willing to sell you this business for $200. Now, let's say we have a second friend who also operates a lemonade stand. It's a pretty hot business. You know, we're in the winter right now, but whatever. And they make $2,000 a year. It's producing a lot more revenue. They have a lot more customers, and they also have a lot more expenses to cover all of those customers. This friend makes $1,000 a year, and they're willing to sell you their business for $5,000. Your question is, which of these two businesses, based off of only the information that we have here, because there is actually external information that could change your mind, but based on just the information we have here, which of these two businesses is a better deal? And some of you, or I would imagine most of you, already intuitively feel like this second business is the better deal for a number of different reasons. But partially what you're doing in your mind is you're actually calculating the PE ratio, and you may not even know that you're doing it, right? So the PE ratio in this case is we're taking this $5,000 purchase price, we are dividing it by the $1,000 that they make per year, and we're going to get a PE ratio of 5. And then for this first business, we're going to take the $200 purchase price divided by how much they're making per year, and that's going to give us a PE ratio of 20. And again, just to be clear, these two numbers are PE ratios. So When we look at two different businesses and don't factor any external information, and that's very key that I say this, when we don't factor in any external information at all, we will always purchase the business with the smaller PE ratio. Another way to think about this is when these two friends approach you, I don't want you to think about the $200 sale price or the $5,000 sale price that they offer you. Instead, I want you to calculate the PE ratio and instead think about that as being the true price for the business. So I want you to think that this first friend's business is $20 and this second friend's business is $5, and you're just going to buy the cheaper business. The reason we use PE ratio, the reason we use ratios at all, is so that we can compare businesses that are completely different sizes, right? I mean, we can see that this business is making 20 times as much revenue as this one. How do we compare businesses like that? Well, we use ratios or multiples. We're not going to get into what a multiple is. PE ratio is in fact a multiple, and multiples are very important for valuation, but we're going to go ahead and explore those in a different video. For now, what's important to understand is I want you to think about PE ratio as the true price for a business, and that is all a stock is. It's a business. I want you to think about that and get that through your head. When you buy a stock, you are buying a business. You should think about it the exact same way. So let's move out of the world of lemonade stands and let's move back into the real world with Apple here. So I don't want you to think about the purchase price for Apple as being $152.29 per share. That's bogus. It means nothing. What I want you to think about is that the purchase price for Apple is $12.57 per share. Now let's compare that to another company. Let's say Microsoft. So let's go ahead and pull up Microsoft here. And you'll find that Microsoft is actually cheaper on a price per share basis. That's why it's complete bogus, because Microsoft is actually a bigger company than Apple at the time of recording this. So I don't want you to pay attention to this price. And even if we were looking at the size of the company, which is determined by market cap down here, that doesn't tell us anything about the valuation in terms of whether it's expensive or cheap. What you want to look at is the PE ratio, and we'll see here that Microsoft trades at $23.17. Again, I just want you to interpret PE as if it's price. So based off of the PE ratios here, we can see that Microsoft is more expensive than Apple. Now, based off of this, you'd always want to buy Apple, right? If that's the interpretation of PE ratio, then why would we not always buy Apple over Microsoft? That doesn't sound right though, does it? I mean, there can't be possibly a circumstance where a stock is always superior to buy over another just on the basis of PE ratio, and you'd be right. So let's start off with defining what this forward part means, okay? And the way we're going to define that is we're going to go back to our example. We're only going to go with the first friend. So the first friend was the person who had $100 in revenue. They had $90 worth of expenses, and they made $10 worth of profit each year. They are willing to sell you the business for $200, and as a result of that, the PE ratio for this particular company, this particular lemonade stand, is 20, right? That's the PE ratio for this lemonade stand. But what your friend provided you here is actually historical information. This is how much he made in 2018. So what we actually call this PE ratio down here is the trailing 12 months PE ratio, TTM. In fact, you'll see TTM quite often when it comes to anything in financial media. It's a very common acronym or abbreviation. I'm not sure which. It's an abbreviation, I'm pretty sure. You'll see it quite frequently. It stands for trailing 12 months. It's just the last year. What's important to understand about this is that this is historical information. But when you go to buy a business, you're not buying a business for what it's done in the past. You're buying it for what it can do for you in the future. So let's say your friend hires a consultant that forecast some of the future estimates for this particular company, for this lemonade stand. And let's say revenue is going to go up by a lot. It's going to go up by 50%, up to $150. But let's say expenses don't go up by much. They only go up from $90 to $100. So now in 2019, it's estimated that you're going to make $50. But we're still selling you the business today for $200. So now we're going to calculate this PE ratio for 2019 by taking the purchase price of 200 and dividing it by 50. And that's going to give us a PE ratio of 4. This PE ratio is called the 1-year forward PE ratio. Okay? That's all it is. It is the forward 1-year PE ratio. And this is where things can get a little bit confusing. Where would we want to use the trailing 12 months PE ratio, and where would we want to use the forward PE ratio? And which one's better? Okay, so theoretically, the forward PE ratio is always better. Because again, when you go to buy a business, you're not buying it for what it's done in the past. You're not buying it for any other purpose than what it can produce for you in the future. And this is going to be trying to give you the valuation of that business moving forward. The problem is your estimates can be wrong. In other words, let's say 2019 passes and instead of making $150, you only made $125, and let's say instead of having $100 worth of expenses, you had $110 worth of expenses. So the business only made $15 in 2019. All of a sudden, we're going to find that this PE ratio is actually going to go up to somewhere between, I believe, like 13 and 14, somewhere in that range. Okay, so the point is, you can actually be wrong with estimates. You cannot be wrong with trailing numbers because they've already happened, right? So the reason that we would ever use a forward PE ratio is because it's better, but we might use a trailing PE ratio because we're not confident in the estimates moving forward, okay? That's the primary difference between the two of them. Now, theoretically, there is an infinite number of PE ratios. We could go into the future, into 2019. We could go into 2021. We could go into 2022, so on and so forth. That would be the 2-year forward, then the 3-year forward, and the 4-year forward. Where do you stop? Well, the truth is, in almost every form of financial media or anywhere that you can find these statistics, you're usually only going to find these two. All right, about 90% of the time, you're going to find one of these two. Sometimes you'll actually find what's called a blended forward PE ratio. Okay, and a blended forward PE ratio is simply taking the combination. We're taking an average of these two. So we'd add these two up. That would be 60, and then divide it by 2. That'll give us 30. And we would take 200 divided by 30 and get 7 something. The blended forward PE ratio is supposed to give us the best of both worlds. It's supposed to give us a little bit of accuracy while also moving forward. It's kind of up to person whether or not you want to use that. But again, 90% of the time, you're going to find one of these two, unless you're using something like Bloomberg or FactSet that can go 2 years, 3 years, 4 years into the future. So if we go back to our example with these two different businesses, okay? If we go back to these two different businesses and we say that the forward PE ratio for the first business is 4 and the forward PE ratio for the second business is 5, we might actually want to buy this first business despite the fact that the trailing 12 months PE ratio is so much higher, just because this forward PE ratio is better. Meaning that on a going forward basis, this company might actually be cheaper. That's where the interpretation of PE can get quite confusing. In fact, there's even more scenarios where it can get even worse. Let's say we have business number one and 2018, let's say, was bad, right? Let's say 2019 is bad. But then moving forward, let's actually do this. Let's say we go into 2022 or 2020. I can't read. Let's say that's going to be an amazing year. Revenue's going to shoot up by, let's say, 75%. Profit margin's going to go up, and that's going to continue on into perpetuity. And let's go with business. Let's draw a little bit better there. Let's go into business number two here. And business number two, let's say, has an amazing, an amazing 2018 and 19. Trying to figure out a way to do this a little bit lazily because I'm very slow at writing. But moving into 2020, moving forward, they have bad financial results. Their revenue starts declining, their profit margins start declining, everything starts going, poorly. Because of the way that PE ratio works, where you're mostly going to see the trailing 12 months or the 1 year forward, you're only going to see these 2 years in the majority of cases. So you're going to miss out on the fact that this company has an amazing future moving forward, right? And that's where the analysis or interpretation of PE ratio can get a little rough because it's very limited in cases where you have years that don't represent the entirety of that company's future or how things are going to work out. So this is why you might see PE ratios that are otherwise quite confusing. I mean, you'll sometimes see PE ratios that are extremely high. Let's go ahead and try to pull up an example here of a company that might have a high PE ratio. Let's look at Netflix. So Netflix has a PE ratio of 83.1. The whole reason that Netflix has a PE ratio this high is the idea that moving into, the 2020 forward years, we're going to see earnings, we're going to see EPS go up by a lot. Hopefully, we're going to see revenue go up by a lot as well to match that. Hopefully, we're going to see profit margin go up as well. We're just going to see the health of the business go up, and that warrants the extremely high price that we are paying even on a 1 year forward basis. So hopefully that kind of makes a little bit of sense. I know that PE ratio can be very sophisticated and may not always be the easiest to interpret, but as you get used to it, it'll become easier over time. The last question that usually gets asked is, what is a good PE ratio? Now that is a very, very delicate topic. But generally speaking, the best way to approach it is you're going to compare your company, all right? So compare to competitors, all right? Compare to comps. The reason you want to compare to competitors is because it's going to give you an idea of where your particular company sits within the industry. So let's say, I don't know, let's go and pull up Verizon. And Verizon has a PE ratio of 12.31. And then let's pull up AT&T. And AT&T has a PE ratio of 8.65. So because they operate in the same industry and likely have similar growth prospects, we can say with some level of confidence that AT&T is cheaper. However, that doesn't mean it's a good thing. See, the reason that the market can sometimes value a company with a low PE ratio like this, and I'll give you another example real quickly here. Let's pull up Ford. All right, so this is another company that has an extremely low PE ratio. Here's another one, GM. All right, so these companies have extremely low PE ratios, and these extremely low PE ratios actually aren't always an indication of them being cheap. It could be an indication of problems with that particular company. So this is always something to keep in mind, is that having a low PE is not always a guarantee that the company is just cheap and you should buy it. And having a high PE is not always a guarantee that you should stay away from a company. I'll give you an example here. Actually, their PE ratio has gone down quite a bit. But there used to be a point where Facebook had a PE ratio of roughly like 50 times. And I still thought that they were a phenomenal purchase because their revenue and their earnings were going up at a very fast pace. And this is usually why we look at things like the PEG. All right, PEG is nothing more than the PE ratio divided by growth rate, right? And the idea is an expensive company should have a higher growth rate, right? And a cheaper company should have a lower growth rate. And the general rule of thumb is that you're trying to get roughly less than or equal to 1. In practice, this almost never happens, so I've kind of upped it to 2. But generally speaking, people always recommend 1, so go with whatever you feel a little bit more comfortable with. But that's just a little bit of extra information. You probably heard of the PEG ratio a few times before. Might as well throw it in. But I hope this video kind of helped with the interpretation of PE ratio. I know it was kind of lengthy and we kind of got into the weeds a little bit here, but you kind of need to in order to fully understand what PE ratio is and how to interpret it. So I hope you guys enjoyed the video overall, and we have plenty more things to talk about. Obviously, there's so many different things when it comes to investing and how to improve yourself as an investor that I would love to talk about. So if you found this interesting, make sure that you subscribe. You know, the typical hit the bell notification thing so that you get notified when I publish a new video. And thank you for watching.